Is inflation going to derail bonds? Hi, everyone. Welcome to the Real Vision Daily Briefing. I'm Maggie Lake. With me today is Kathy Jones, Chief Fixed Income Strategist with Charles Schwab. Hi, Kathy. How are you?
Fine, Maggie. Thanks for having me on the show.
Yeah, thanks for coming back. It's great to have you. So, such an interesting week. We saw stocks were kind of flat to mixed. Treasury yields slightly lower in today's session, but you just get the feeling that everyone's just marking time ahead of what's going to be some really key inflation data. And we've got several reports coming out this week. What are you expecting to hear on prices?
Yeah, I think the consensus estimate for CPI is up 0.3%. That seems like a reasonable enough estimate. We're now in a place where people want to take it out to 2 or 3 decimal points to to try and evaluate the underlying trend, which is getting a little ridiculous. But I think 0.3 is consensus. That seems like a reasonable enough estimate. I don't see it quite as life and death as a lot of people do. We have a lot of inflation data to sort through. But yeah, I think, the market's poised, I think, for the possibility of a bad number. So everybody's kind of holding their breath.
Yeah, that's really what it is, isn't it? It's not that, we always say you need a trend and you need multiple readings, but there seems to have been a shift in sentiment that that's the best news on inflation, that, lower trajectory that was helping bake in those Fed easings. eh, Maybe that's at risk. And maybe not only are we not seeing a decline anymore, but now we're seeing a reinflation or higher inflation. And that's throwing this rate outlook up in the air. That seems to be the concern. Do you share that concern?
Well, I think it is a concern that we've seen a couple of months of more, a little bit upward trend month to month, a little more sideways action, if you will. And we do want to see it continue to come down. We do want to see the monthly readings be, zero point 0.2 or so to continue the overall trend down. But that being said, I'm not overly concerned. I think the market's making a big deal out of a lot of short-term information here. And when you do look at some of the leading indicators on inflation, especially the core PCE, which the Fed is targeting, you see things that are signaling lower inflation, such as the ISM Services Price Index, and services where the inflation numbers have been sticky. That's really fallen now. So that may be an indication that supply and demand in the service sector is coming back into balance. Also, the quits rate in the JOLTS report, that typically will give you kind of a good leading indicator of where we're going wage-wise and inflation-wise. So the things that correlate with future inflation are still in pretty good shape, but we do have to get through this near-term uncertainty as to whether that trend will continue or whether we're just going to move sideways here a little too high for the Fed's comfort level.
Yeah. And it matters, I think, to people, especially now, because we're getting into that zone where even with the recalculation, people were kind of targeting that late spring, early summer for those rate cuts. And so if you don't start to get evidence of it, and part of the equation too is that the economy seems like it's been, we keep hearing the economy's resilient. It seems like it's been more than that, more than people expected. Can we grow the economy? Can the economy run hotter without the risk of inflation coming back and causing a problem for the Fed? What do you think the discussion is with the FOMC right now?
Yeah, I think that's the big debate. That and, where is the neutral rate? Should the neutral rate be higher because the economy has the ability to grow at a faster rate, and therefore we don't need to be, looking at slower growth ahead in order to get inflation back to 2%. So I think the debate really is have we reached a point where we can't do any more good on inflation because the economy is running too hot, it's a demand side too strong, or are we getting enough in the way of supply response that we can continue to see growth without generating a lot more inflation? I'm more on the optimistic side about it. I think that we do have a lot of growth potential. We've seen a pickup in productivity. That's notoriously difficult to measure, and especially in the short run. But it does seem that we've demonstrated that, yeah, you can have lower unemployment for a long period of time. And as long as you're getting more people into the workforce, you're not generally overwhelming the economy on the demand side. So I'm more optimistic than many that we can get there without having to kind of crush demand. But I'm not sure that the Fed is there or that the market is 100% there. So, that's why they're data dependent now. We're just going to have to wait and see how it plays out.
Yeah, they love to say that. And it did seem for a bit that they were really committed to staying on that easing path because even in the face of some hot data, they were talking about it. But so many have come out and seem like verbally they're sort of setting the stage for, well, we've got to see, maybe not. What does that mean for the 10-year? Because we did see the 10-year yield move back up. And of course, everyone's watching rates because of the impact it has because we've seen so much bond volatility in treasuries over the course of the last year as everybody tries to anticipate that lower rate and then they've gotten their head handed to them. So we've seen rates move up, but they're still hanging down around that 4.3, 4.4 level. We haven't seen that fear bring them all the way back up to 5%. So I'm just wondering how you think this trajectory looks as we move through these critical meetings that are coming up, because it's got to affect everything else in the bond world for you, I would think.
Oh yeah, absolutely. So it is important what the Fed does. So when we break down what drives Treasury yields, particularly 10-year yields, it is Fed policy, it is inflation, and it is economic growth. And a lot of the rest of it is noise, right? You get a lot of people throwing out ideas about what's driving the market, but Fed policy, inflation, economic growth, and where we have such uncertainty is Fed policy now. So yeah,
Mm.
we came into the year, it was like, okay, we're going to cut rates, 3 times in the dot plot. And all of a sudden now we're hearing from various people at the Fed, like, well, maybe it'll be one, maybe it'll be none. I don't know. We have to wait and see. And that throws the 10-year off because, to some extent, long-term rates are, a function of short-term rates, that discounting, and inflation expectations and economic growth. So when you take that one factor, Fed policy, and you throw it up in the air and say, yeah, maybe this, maybe that, we don't really know, then you get a lot of volatility in the market. And I think what we're doing now is reacting to every single data point as if it's decisive, right? That it's not an accumulation of data, but it's like, okay, CPI is this, therefore, no rate cuts this year. Or CPI is that, okay, let's pencil in 5 rate cuts. So we're just all over the place. We came into the year expecting 3 rate cuts starting in the second half of the year. We're sticking with that forecast just because we don't have any reason not to stick with that forecast yet. Obviously, it could be 2, I think would be a plausible outcome as well. We're listening to people like Raphael Bostic from the Atlanta Fed, who was in favor of cuts and now is like, oh, maybe 1. But you can tell that this is just everybody trying to game it at every data point. And I think that gives us a lot more volatility, particularly at the long end, which is a big function of inflation expectations.
Yeah, it's so true. We've been just sort of describing it as everyone running from one side of the ship to the other, and it has created this volatility in bonds, especially treasury bonds. When you're not traditionally used to seeing some of the swings. I mean, we're certainly not at the point we were last year, but uh, you brought up a couple of points I want to get your thoughts about because the Fed is so central. And one of them, Raoul Powell and Julian Brigden sat down for a macro insider conversation, and they discussed the idea that central banks may not have a lot of options. I mean, this is something we hear that kind of backed into a corner. Let's listen to that clip, and then we'll talk on the other side.
How I think it through is, let's say Jim is right. I don't have a view on the bond market right now because I think there's, this whole issue of issuance and deficits is something we hadn't really faced in the bond market for a long time. But let's say he's right. What happens? And my answer is they will have to do something because they can't refinance the debts at 5.5%.
Right.
So I think markets know this. So let's say he's right. That would be a confirming factor why gold is screaming higher. The markets are kind of telling us that we've got a problem somewhere. And whether it ends up having to be yield curve control or whether it has to be whatever mechanism they will use, they will find a mechanism.
They'll have no
They
choice,
have
man.
to, because
They
as
have
Julian
to.
said, the big boss can't go bust.
Yeah. I mean, I think you get pain before you get there, mate, but I totally agree with the long-term outcome. They have to. There's
Well, see, I
absolutely...
don't know if you'll get the pain because the markets see through it. That's my thesis here, is like,
yeah,
all seeing through it. It's like,
yeah, and that's why I'm not waiting for the pain to buy
with
it.
real rates, gold should be falling, right? With the dollar, gold should be falling. It's breaking out, right? That's a huge macro signal.
Correct. I agree.
It's based on something.
It was a fantastic conversation because those two haven't sat down in a few weeks together, and you can get the entire conversation on our website. If you are not a member, you can hit the link that Brian put in the chat and join. So Kathy, it's this comes up a lot when people are also trying to not only game the inflation data, but look at this bigger issue of debt. And one of our members in the chat just said, Fed policy, inflation growth. What about Yellen in the background pushing liquidity? LOL. But is this idea that there is this debt issue, they can't afford the interest rate payments, and sort of the market is sniffing that out. And that's creating some of that tension as well as people try to figure out when that easing is. How do you think about that issue of debt, that bigger issue, as you're trying to look at least through the next few months here?
Yeah, I think it's really difficult to tie short-term movements in treasury yields to supply. So I have spent many, many hours of computer time, a lot of brain cells, trying to find an actual statistical correlation between supply, between issuance and yields. And frankly, it's been unsuccessful effort. And I say this going back decades to when I was on a trading desk, and I sort of always had this thought that was expressed to me by traders like, oh, every time there's an auction, yields have to back up a little bit to absorb the supply, and then we rally. And I thought, well, if that were true, that's like a guaranteed trade, right? Like I'm going to do this trade. And then, of course, I ran the numbers, and it turns out that you got a 50-50 shot of being right about that. So I don't want to overemphasize supply in the short run. I think in the long run, obviously, our buildup of debt is a big concern. Right now, the current rate on that is around a little less than 3%. So we're not financing it all at 5.5%, nor will we have to going forward because, the Treasury has a lot of options. So I'm probably less concerned about that being a 2024 issue as it is a longer term issue. We have the exorbitant privilege of having the world's reserve currency, which does give us a sort of a guaranteed audience, a level of demand for treasuries, and there's nobody kind of challenging that right now. So in an ideal world, we'd outgrow our debt, right? We'd grow faster than the debt grows and would come down relative to GDP. That clearly isn't something Congress is embracing right now with the budget. So I do worry about it. Longer term, how much more do yields have to go up to attract foreign capital, to attract domestic capital? But right now, we don't see evidence that that's a real problem. Foreign buying continues to be pretty strong. Domestic demand at these yields has been very strong. Households have been buying a lot of treasuries. You put money into a money market fund and you're buying treasuries. So right now, these levels demonstrably are enough to attract capital. But obviously, as we go longer term, it's a problem. As for gold, over the years, typically you do see an inverse correlation between real interest rates and gold prices. So this is a little unusual seeing this divergence. I don't know whether it's though concern about the buildup in debt or just expectations that those interest rates are coming down. We've had so much talk about easing policy, not just in the US, but the ECB, et cetera. So it may be the market is building in that expectation. And then we've had strong demand out of Asia, maybe some central banks like the People's Bank of China trying to diversify their holdings a little bit. But again, hate to read too much into this move in gold, translate it directly back to the Treasury market. I think there's a lot of dots to be filled in there.
Yeah. And it is the tough thing about this macro environment because there are so many cross currents that it's very hard to look at that. It reminds me of something one of our frequent guests says, like, I have to trade the market in front of me, right? So there's a longer term
Right.
conversation about debt and what that means, but right now you have to trade what's in front of you. So we have another question. I think we've already sort of answered this, but I just want to be clear about it. Ralph asking, are you in the higher for longer or some other camp? You're expecting easing. So it sounds like you do expect rates, the Fed rate, funds rate to go down and therefore treasury yields as well. Are you looking at a range? Do you think that, it sounds like you've maybe thinking about paring back how many rate cuts you think they're going to do. So what do you, what camp do you think you fall in here?
Yeah, I'm not. I think higher for longer implies, years of high interest rates, and I don't expect that. I do expect some Fed easing later this year into next year, but I don't think we're going back as low as the Fed's projections. That 2.5% Fed funds. Maybe during a recession we'll get there, but as a resting place, 3.5 seems to be more realistic, assuming the dynamics in the economy continue, which is, big assumption. But we have seen, a big pickup in labor force participation that should drive productivity. It should drive economic growth. More people working, more people earning a check, means more spending, more demand in the economy. And that would tend to indicate, yeah, we should have somewhat higher rates. 2.5 was probably a post-financial crisis kind of environment. We're in a different environment now. But I don't think 5.5 is the resting place. I think 5.5, particularly with 300 basis points of real rates, is pretty high. And particularly when you look around the world and you look at, still sluggish growth in China, weak growth and falling inflation in Europe, Japan kind of fighting its way out of deflation. I'm not really sure we're going to make the argument that there's such a robust global economy that we need to have 5.5% rates or 3% real rates in the U.S. for years to come.
Yeah, I think that's such an important clarification because when we were in that super low interest rate environment, everybody was pointing out and worried about us being in a sort of deflationary spiral we could never get out of, and that they were really too low, or the fact that they were so low is indicating something anemic and not great about the economy. So the fact that we're higher, maybe not the worst thing, but where that settles is causing so much angst right now. I think when you're talking globally, this is another point that I wanted to bring up that's come up today. You had Mohammed Al-Arian talking about, are now the global central banks on on a different pace from each other? Are we going to see, it's really been coordinated for a long time in working in lockstep, whether intentionally or not. But do you think now we're going to see a differentiation between who goes when? Could the U.S. hold rates or be more reluctant to cut rates, and we can see the ECB going beforehand, or other central banks? We've already seen a couple move. Are we going to see a big divergence, and what does that mean?
Yeah, we are used to this sort of synchronized activity with the Fed in the lead, the Fed being kind of the central bank to the world, right? That what the Fed does, everybody else does eventually. And this time does seem different. Just like so many things about the cycle are different, this time does seem different. So, you've got the big three. You've got the U.S. holding off maybe on rate cuts. You've got the ECB probably going in June from all the indications that's a likelihood. And then Japan raising rates. So we've got a lot of divergence already. As you mentioned, a couple of central banks have already cut rates. Emerging market central banks, seen some rate cuts there from very lofty levels. So this is going to be the first uncoordinated, or at least, not synchronized cycle in a long time. And I think how that plays out is in the foreign exchange market. I think you see a lot of the volatility in rate expectations playing out in the foreign exchange market. We've seen the euro come down. We've certainly seen the Japanese yen come down like crazy, despite the hike in rates, because it's expected to be slow. So I think the first tip-off is in the FX market, and then it translates maybe into more broadly into the fixed income markets. But yeah, it means again probably more volatility, more people trying to figure out who's going when, where, and how fast. So in amongst the major central banks, ex Japan, the direction of travel is likely to be lower in rates. The speed is going to vary, and the final destination is completely up in the air. So there's a lot for the market to try to deal with, and this may be a more volatile cycle than we've seen for a long time.
Yeah, which, as we know, when there's volatility, there's also opportunity. So let's talk a little bit about that, because it was important to spend that time, I think, on what's happening with treasuries because it matters so much. And it's been such a source of confusion. But where do you see opportunity in the bond market?
Well, we've liked investment grade corporate bonds. And now the spread's very, very tight right now. And we're seeing some differentiation amongst the various ratings in terms of performance of the bonds. But in an environment that we seem to be in where corporate profits, they hit an all-time high last quarter. They're still growing. The economy's still doing well. They're tolerating high interest rates because they probably termed out their debt, or they've got just enough demand that they can handle the interest payments. So investment grade corporate bonds still deliver 5% plus. And so for investors, we have a lot of people sitting in short-term in cash, money market funds saying, well, I'm getting 5% plus. Why should I go into a treasury with longer duration for a lower yield? That doesn't make sense to me, except for reinvestment risk. As we get rate cuts down the road, there'll be some reinvestment risk, but I can understand the reluctance. If you want to lock in some of those cash flows, we think investment grade corporate bonds at 5% plus, 5 to 7 years, it's a way to extend duration without giving up a lot of yield. And that, for us, that's an opportunity. High yield, you can clip the coupon probably and do okay. Again, valuation wise, spreads are very, very tight. If there's a glitch, something goes wrong, those spreads tend to really widen really fast. So,
Quickly, yeah. Are you surprised they've stayed as tight as they have? Because so many times we've had people ask about that, even when it looks like there's stress in the system, just surprised that high yields hung in so well.
Yeah, it has surprised us. We've been more cautious than probably we needed to be. And I think when I look at it, what we see is that some of the companies were able to term out their debt, but I think a lot of it, this market, there's just tremendous demand for yield still. After being starved for yield for a decade, people look at high yield, they say 6, 7, up to 8%. I can ride out a lot of volatility as long as I don't get a big spike in defaults and the economy doing well. I'm not too worried about defaults. So we're seeing that demand every time spreads start to widen, that demand really comes in. We also had a lot of participation in the market on the private credit side. So it's taken some of the supply away that normally would probably have ended up in the high yield market. So I think that's been a component as well. But it has held in, but still a little bit cautious because, when the spread moves, it spikes. And, you got to be prepared for that.
That's so interesting. The private side has been active in buying. So that's a buyer that's been in the market that maybe wasn't to the extent before. Is that what you're thinking? And do they feel like hands that'll hold on to that? Or do they also sell when things get, does it give a little bit more stability to the market given that it's coming from that area?
Well, we won't know until the cycle plays out entirely. I think a lot of small companies have gotten financing on the private credit side. And, the deal you make when you invest in private credit is that, you're supposed to be committed for a long period of time to get those higher rates of return. And they can put up gates. So you give up liquidity, right?
Yeah.
So the question becomes, if we hit a real serious problem in the market, and people can't get their money out, do they sell something else to get liquidity, right? And that's one of my concerns about high yield. Do we say, oh, well, I can't get out of this, I have to sit tight here, but I need liquidity, I'm going to sell over here. And we don't know yet because we haven't hit that point in the market.
Point.
Yeah, we may
Super
not.
interesting, super
Yeah.
interesting to bring that up because it's a dynamic that maybe wasn't in play last time. I'm guessing that thing they sell is gonna be liquid, so it's either gonna be bonds, but if you're private credit, maybe equities that you're holding.
It very well could be because a lot of private credit is really much more correlated with equity than it is with
Right,
fixed income. So
right.
it's a possibility. Just don't know. We just
Yeah,
don't know.
yeah. That's why these markets are so complicated. For those who are even further out onto the risk curve, I know you're looking at emerging market bonds.
Yeah, we actually have liked local currency emerging market bonds. And the reason is that we think that if the cycle plays out as we anticipate, usually Fed easing is good for emerging markets, right? It's a healthy signal for growth. A lot of these countries are, major exporters of commodities. Commodity prices have been coming back up. It's usually a positive signal when the Fed is in the easing part of the cycle.
Mm.
And when we look at the universe, it's really a varied universe. So you have to be careful. But the ones issuing in US dollars, actually, that universe is now really dominated by like China. You've got a lot of issuers like Argentina that, can only issue in US. Whereas in local currency bonds, we've seen more discipline. Again, I'm generalizing here because not every issuer is disciplined, but we've seen more discipline on inflation. We've seen more discipline on the fiscal side than we might have seen in other cycles. And so risk reward, we look at it and go, well, you get a pretty decent yield if you're willing to ride that wave. We think that there's an opportunity here. Now they've moved a fair amount in the last couple of months, so we may see some pullback here, but the yields are pretty attractive. If you can get enough diversification, maybe find an actively managed fund to kind of avoid the landmines, then I think for somebody with that kind of risk tolerance, it can make sense.
Yeah, I think that's important what you said because that's the one thing about funds, right? That you really need to look at what they're holding and the underlying. And we talk about that when we're talking emerging market equities, but the same thing holds true for bonds. And there are very different dynamics of countries that tend to get grouped into emerging markets. So you have to really sort of understand what you're buying and really do the deep dive in there and find out not only is it actively managed, but what are the largest holdings and does that correlate with what you're hoping to achieve in there. We have a great question from MJ um, asking, what does the potential bear steepener yield look like? Will the bear yield help regional banks build back reserves? Or do we have a situation where they're sitting sideways, not loaning because they're concerned? How are you thinking about that banking system? Every once in a while it flares up and everyone gets concerned, but then it seems ring fenced. And how do you see rates affecting that?
Yeah, well, a bear steepener would not be helpful for the banks, right? A bull steepener, where rates come down across the curve, but they come down more at the short end, the long end, and you get a normalized yield curve, could be helpful for the banks in the sense that you're just getting lower rates across the board, higher bond prices, shores up their capital, makes lending much more profitable, right? Because you borrow short and lend long, you finally uninvert the yield curve. When you get a bear steepener, you're lifting yields across the board. So you may not get as much benefit from the steepening of the yield curve as you do in a bull steepener. So I don't think a bear steepener is probably extremely helpful to the banks that have problems. But I at this stage of the game, never say never, but the banks should have figured out how to deal with this environment, right? I think the ones you worry about are the ones with a lot of exposure to commercial real estate, because that's kind of a slow burn that just doesn't seem to be getting fixed very quickly. And that probably is a tripwire for a lot of these smaller banks with those sorts of issues. So, I would be looking very carefully about what's on that balance sheet. What are the assets and how exposed are they to commercial real estate? I think that is the bigger issue than whether the curve steepens or flattens, or it's a bull or a bear steepener from here.
Yeah. The last question I wanted to ask you, Kathy, when we're looking at corporate bonds, so, traditionally this is investment grade, the higher the grade and the rating, the safer, the further out you go, the further you get into so-called junk or just lower grade, higher risk. Is there any sector consideration in that now? And I only ask because there's so much attention on technology and the Mag 7 and whether they're falling down from a sentiment point of view. So obviously many of them have investment grade ratings, but do you look at it through a sector lens at all in terms of concern about what future growth may be?
We do, although I would say in the corporate bond market, you haven't seen as much concentration of issuance as you've seen, like, what's going on in the stock market, right? So
Mm.
it is a more diverse and has maintained more diversification than we've seen uh, elsewhere. So we're not seeing like one big sector that's really vulnerable to some sort of fallout, as you have seen, maybe in the equity market. So it's been a much I don't see maybe a more rational market. I guess I would
Yeah.
say people haven't all piled into one type. Now, obviously, you could run into trouble in one sector or another, and you have to look at the leverage ratios and all that. But we haven't seen the same concentration risk that we see in the equity market.
That's great. Kathy, so fabulous to have you come on again and get a chance to sort of drill in what's happening with the bond market since everything else is keying off it. We really appreciate it.
Thanks for having me.
Thanks for coming on. We look forward to seeing you again. Thanks everybody. Thanks for the great chat. We'll be back same time tomorrow. Be all over those inflation numbers. So we'll see you then. Take care and good luck out there.